Hello and welcome back to Mr. C's Accounting, where we're now looking at the issuances of common shares. So let's get to it. So when accounting for common share issuances, we need to remember that shareholders' equity in a corporation consists of two components: contributed capital and retained earnings. Now, the issuance of common shares only affects contributed capital. So in terms of the first type of shares, which is no par value, we're going to look at an example where ABC Company is authorized to issue 5,000 no par value common shares. On January 1st of whatever year, 1,000 shares are issued for $10 a piece. At this time, we get cash for 10,000 and common shares credited for 10,000. And that's because shares are usually sold for cash. And so once the shares are issued, we make this entry. And no accounting is required for the 4,000 unissued shares, because even though we have authorization to do up to 5,000, remember the whole transfer of ownership principle we talked about earlier in the year? We've been authorized to issue 5,000, but until we actually issue them, no entry is recorded. So continuing with our example, afterwards, on April 5th of whatever year, another 1,000 shares are issued for $15 each. So in this case, the entry would be exactly the same, just the dollar value is different. So par value shares are pretty straightforward. Stated value shares are a little more interesting. Their name is the biggest clue as to what the difference is. So as far as stated value shares go, cash proceeds from issuing stated value shares that can be equal or greater to the stated value. So essentially, a company is saying that the shares have this value. It could go higher than that. Who knows? If the company does really well, the value of those shares will skyrocket. But if the company does very poorly, the stated value is sort of the price floor, if you will, and the value cannot be less than that. So, for example, going back to ABC Company, if it's authorized to issue 5,000 $5 stated value common shares, so if that happens on January 1st at whatever year, the entry for that will be we debit cash for 5,000 and credit common shares for 5,000. So if the value of the stated value shares, I'll back up, if the shares are issued for what their stated value is, then there's no change in how we would record the issuance of those shares. Where the change happens is if we sell those shares for more than their stated value. So let's say $10 per share. If that were to happen, then the entry gets a bit more complicated. And it looks like this. We still debit cash for 10,000. We still credit common shares for the stated value. What happens with the extra money is it goes into what's called contributed capital. And then in our explanation, we just write in excess of stated value. And so, as you guys know, every entry has to balance out. So we have 10,000 debited, so we need to have 10,000 credited. And just remember that when you're dealing with stated value shares, you always record for common shares what the stated value is. Anything more than that contributes directly to the company's capital, so it's fairly straightforward to remember. You can think of this as profit, if you will, in that this is the amount that's greater than what the worth of the shares is stated to be. Now, after these two share issuances, we have total contributed capital of $15,000. 5,000 from the original issuance of shares where they sold at their stated value, and then 10,000 from when the shares were issued at a value higher than their stated value. Now, the thing to remember is that legal capital consists of what the common share value is. So all the 5,000 goes into legal capital because the shares were issued at their value, their no par value. However, from the 10,000, 5 of which was higher than the stated value, we only put the stated value amount towards legal capital. So that's why legal capital would be 10,000 instead of 15,000. Now, in terms of how this would look on a statement of shareholders' equity, contributed capital is its own section of the sheet. We have our common shares, 5,000 shares of $5 a piece, were authorized. So note that we write what the authorization here is, and then we say how much has been issued so far. The 10,000 consists of the $5,000 for the shares that were issued at the stated value of 5, and then the 5,000 from the shares that were issued at 10, even though their stated value was 5. So the stated value is what's aggregated in this amount here. Afterwards, we have contributed capital in excess of stated value. So anything over what the stated value is then recorded here. We then draw the line to show that we're going to sum up the total to get the total contributed capital of $15,000. Oh, I forgot about that. So this retained earnings is just an assumed amount. So don't think that somehow the 15 and 5 generated the 20. It didn't. 10 plus 5 is the 15. This value is assumed. And so then in the statement of shareholders' equity, after we've gone through documenting what's happened with the shares and the retained earnings, again, this is an assumed value. We have our total shareholders' equity of $35,000. So, issuing shares for things other than cash. Again, cash is the most common way that shares are purchased, but it can be purchased for other things. Shares can be issued for things like services or non-cash assets. It's up to the company to decide how the deal is made, essentially. Now, the big question when shares are issued in exchange for either services or non-cash assets, how do we recognize and record the value of those shares because they're not being sold or issued for a cash value anymore? Now, the thing to remember, and this is a principle in accounting in general, but you always want to gravitate towards the most concrete and the most reliable source of information. Now, we've dealt with this principle before. For non-cash transactions, the cost is equal to the cash equivalent price, if we can find that. And the cash equivalent price is equal to the fair market value of whatever's been given up, not what we're getting. And the reason for that is that we have a better understanding. When I say we, I mean accountants. We accountants have a better understanding of what's been given up versus what we're getting. So, like I said, in accounting, it's all about using principles and techniques that allow you to operate with the most clarity and reliability as possible. So that's why looking at what this issue and dealing with these vague things, when we're trying to record the non-cash value of an asset, we look at the fair market value of what's been given up. So, if fair market value of consideration is not determinable, so in a question, this will be given to you, by the way. But if it's said that it's not determinable, then the cash equivalent price is equal to the fair market value of the consideration being received. So that's because, like I said, we have a better understanding of the value of something we've given up than something we're getting, because what we're getting is new, or new to us anyway. If we don't know the value of what we've given up, though, then we have to operate based on what we're getting, because that's the next best reliable thing, if you know what I'm saying. So, for example, a lawyer performs what he would describe as $5,000 of services for ABC Company. So on December 31st of whatever year, the lawyer agrees to accept 1,000 no par value common shares as payment. So in this case, because the only thing we know with certainty is the dollar value that the lawyer has assigned to his or her services, could be much less than that, but that's what the lawyer is saying. And there's no established market price for shares at this time. Now this is an important point, because if there was an established market price for what we're giving up, then we would go for that, right? In this instance, the value of consideration received is the best measure of shares issued. So, I mean, he could be lying about this. Lawyers often, bill twice as much time as it actually took to do something. But this is the most reliable source of info we have, so that's the one we use. So in this case, we would debit legal fees and credit common shares. Legal fees is an expense, by the way, just to make that clear. So another example. ABC Company issues 1,000 no par value common shares to acquire machinery advertised for sale at $15,000. The current market price for shares is $10 per share. So now we have two sources of information, the market price and the machinery advertised cost. Which one do we use? If you said the machinery cost, then you are absolutely wrong. And you should suffer. Again, we're using the most reliable. I don't know why that's so funny to me. It shouldn't be. Again, we use the most reliable source of information here. And in this case, a current market price for what we're giving up is more valuable than an advertised price for some random piece of machinery. So we use this. So then the entry for the machinery would be 10,000 as well as the common shares. This is an interesting thing to remember. Even though the machinery is priced at that, again, we value things by the most reliable amount available. And in this case, the most reliable amount is the market price that's been established. So even though the machine was priced for more than this, and it may be worth more than this, we're valuing it by the amount of the asset that we are giving up. In this case, $10,000 worth of common shares. And that is it. So I hope you enjoyed this video about common shares, and I hope it made things a little bit clearer. And I will see you in the next video. All right, bye.